Welcome everybody to this December 6th edition of Economic Impact. As usual, I am with our chief economist, Stéphane Marion. Hello, Stéphane.
Hello, Martin.
With a new background. So, Stéphane, we have no choice. We need to talk about the evolution of the sanitary crisis. Where do we stand?
Yeah, Martin, it's our last show for this year. I wish we could speak to something else, but unfortunately, again, an update on the pandemic. And you can see on this slide that number of cases has increased quite significantly across OECD economies. However, Martin, silver lining, the red line, casualties are not surging in the same way as what we saw previously. So perhaps there's some hope on this front, particularly with the new variant, Omicron, that was discovered just a week ago or so, 10 days. And you can see that from a South African perspective, the number of cases that are impacted by Omicron has risen quite significantly. So at this juncture, Martin, we don't know how lethal it will be or how widespread or how lethal it could be both for the health system or the economy. We'll have to find out in the coming weeks.
Indeed, and we asked our specialist, Dr. Weiss, to be with us. He's waiting for some more data, but within a couple of weeks, Stéphane, we should know more. And he told us so far he's not too dark regarding this variant. So let's wait and see. We'll be back in a couple of weeks with more data. But meanwhile, we got some economic numbers in November, and they're pretty good.
Still pretty good. So I'm happy to hear that Dr. Weiss is not overly bearish going forward, but we'll find out. But clearly, world manufacturing activity, Martin, is doing quite well, comfortably above the levels that normally suggest contraction. So we're looking at positive growth going into 2022. And Martin, when you have this level of activity, it's normal that you see a bit more inflation. So yes, the economy is doing well enough to generate more inflation on a global basis. Let's
look at Canada. I think we're reaching some new heights, a couple of decades.
We're definitely not the exception, Martin, with inflation at 4.7%. Okay, it's not 6.2% as in the US, but 4.7% is something we haven't seen in 18 years. And even if you exclude food and energy, it's still well above the 2% target range by the Bank of Canada. So under these circumstances, I think the Bank of Canada could be justified to move sooner. I think were it not for the variant, the new COVID variant, they could move as soon as January. But now we think it could be, if it's not January, it could be March.
Wow, that's a little sooner than you expected, right?
It is, Martin, but it reflects also what's happening in Canadian labor markets, right? We had surging employment over the past 2 months, more than 200,000 jobs in 2 months. And that has propelled the labor force participation rate for people 25 to 54, so prime age workers, to a record high. Look at this massive divergence with the US. Wow. So it seems to me when I look at this, Martin, is that, hey, we're pretty close to full employment here.
It is. That's a question we had just a couple of weeks ago, but I think it's pretty clear. And when we talk to our entrepreneurs, they pretty much confirm this, right?
And if you can have the anecdotal evidence, but on top of it, the hard data suggests that it's absolutely true, Martin. The key concern for small businesses right now in Canada is shortage of skilled workers. So clearly, Martin, yes, it does suggest we're at full employment, and the Bank of Canada could be justified to move sooner with rate hikes.
We've talked about immigration in the past, but maybe we need to look beyond immigration. Any other solutions?
Well, solution to skilled, shortage of skilled labor. Yes, immigration is part of the story, Martin. But at the same time, if you're bringing people, you want to make sure they have a large amount of capital to work with to promote growth even more. And clearly, what you have there right now, we've been maybe over-reliant on immigration and not paying as much attention on investment. And what you can see on this slide, Martin, is that for the first time since 1961, the private capital stock in Canada has contracted. So investment is not keeping up with depreciation. We need to do better, Martin. We need to invest to boost productivity going forward.
And Stéphane, you and your team published a special report titled "Canada Can't Afford to Bleed Capital Like This." It's very fundamental, must read for many of our listeners. Tell us a little bit more.
Yeah, the issue here is that we have to do better to promote our growth down the road. We need more capital to work with. Right now, the situation is unacceptable, and you can see that from a manufacturing standpoint, our manufacturers are now operating with the level of capital stock that is no higher than it was 35 years ago. So, Martin, we must breach this gap. I think the responsibility of our governments is to provide our entrepreneurs at least good visibility about market access, so we can have this U.S. government becoming overly protectionist. So I think there's a job there to be made by Ottawa. Also, at the same time, we have to be more responsible on how we assess, corporate taxes. So let's find out what the federal government does in the next couple of weeks. But I think there's clearly a justification here where we have to adjust our policies to attract more investment in this country.
Excellent. This report is available on our website. Again, I encourage all of you to take a look at it. So we had a good 2021. We're concluding with a little bit of worry, as we talked about, with the central bank pulling off a little bit. We seem to have a risk-off trade going on, which was a little bit expected. And now all eyes on the economic update by Chrystia Freeland mid-December, as well as more data on this new variant. We'll be back to you in a couple of weeks. Thanks for listening. Thanks for being with us, Stéphane, and we'll be back shortly. Thanks.